The US dollar just posted its worst 6-month decline since 1973, down 11% against a basket of major currencies in the first half of 2025, the biggest collapse in over 50 years. And Goldman Sachs is forecasting another 10% drop against the euro, pushing EURUSD to 1.25 by the end of 2026. Think about that for a second. The world's reserve currency, the backbone of global trade, the safe haven asset that's underpinned every major financial system since World War II, is in free fall. And it's not slowing down. Morgan Stanley says we're at the intermission, not the finale. The second act of dollar weakening is coming over the next 12 months. But here's what they aren't telling you: this isn't just a currency correction. This is structural. De-dollarization is accelerating. Central banks are dumping. U.S. Treasuries at the fastest pace since 2012. Gold reserves just overtook dollar holdings for the first time in history. And if the dollar loses its reserve currency status, the American standard of living collapses overnight. So the question isn't whether the dollar is weakening. The question is, are we watching the reserve currency collapse in real time? But before we reveal what breaks when the dollar hits 1.25 against the euro, you need to understand the three forces driving this death spiral. Because this isn't about interest rates or inflation anymore. This is about trust, debt, and the weaponization of the dollar itself. Let's start with the number that flipped everything: 10.7%. That's how much the dollar index fell in the first half of 2025, the worst performance for this period in over 50 years. The ICE US dollar index, which measures the greenback against 6 major currencies including the euro, pound, and yen, collapsed from January through June. It recovered 3.2% in July. But Morgan Stanley says that was just a temporary bounce. David Adams, head of G10FX strategy at Morgan Stanley, said, "We're likely at the intermission rather than the finale." The second act for the dollar's weakening should come over the next 12 months, as U.S. interest rates and growth converge with those of the rest of the world. Translation: the dollar's 15-year bull run is over. The structural cycle that started in 2010 and delivered a 40% gain? Dead. So what triggered the collapse? Force number 1: Trump's tariff chaos. President Trump's unpredictable tariff policies have alienated U.S. trading partners and sparked fears about the Federal Reserve's independence. Tariffs were supposed to strengthen the dollar. Basic economics says if you slap tariffs on imports, demand for foreign goods falls, and the dollar strengthens. But the opposite happened. Why? Because Trump's tariffs weren't consistent. He imposed them, suspended them, increased them, and decreased them. That created uncertainty, and investors hate uncertainty. Barry Eichengreen, professor of economics and political science at UC Berkeley, told CNN, while tariffs can theoretically bolster the dollar, they have also introduced a level of unpredictability regarding U.S. policy that has dominated the markets this year, pushing the dollar downwards. Eric Nelson, macro strategist at Wells Fargo, put it bluntly: it's U.S. exceptionalism basically falling by the wayside and the rest of the world playing catch-up. Force number 2: the twin deficits. The U.S. is running a federal budget deficit of over $2 trillion a year. The current account deficit, the gap between what the U.S. imports and exports, is also ballooning. These twin deficits have grown by $11 trillion cumulatively since mid-2009. Here's why that matters. To finance these deficits, the U.S. has to sell Treasury bonds to foreign investors. But foreign investors are losing confidence in U.S. fiscal sustainability. Federal debt now exceeds $36 trillion. And when foreign investors lose confidence, they stop buying treasuries. They start dumping them. Force number 3: de-dollarization. Central banks around the world are actively reducing their dollar holdings. Fed custody holdings, which track U.S. treasuries held at the New York Fed on behalf of foreign central banks, have collapsed to $2.78 trillion. That's the lowest level since August 2012, and a decline of $130 billion in just 2 months. At the same time, central banks are buying gold at record levels. In just the first quarter of 2025, central banks added over 244 metric tons of gold to their reserves. With gold prices now above $3,500 per ounce, the value of central bank gold holdings has reached around $4.5 trillion, significantly surpassing their $3.5 trillion in U.S. treasuries. Steve Barrow from Standard Bank said, The swift decline in these custody holdings may indicate that central banks have grown less favorable toward the Treasury market and the dollar recently. Translation: the world is losing faith in the dollar. So what happens when the dollar continues to weaken? Goldman Sachs is forecasting EURUSD will hit 1.25 by the end of 2026. That's another 10% drop from current levels. Around 1.14. Scotiabank sees EURUSD consolidating near 1.17 by end of 2025, with scope toward 1.22 into 2026. But here is the mechanism they don't want you to see. If the dollar weakens by another 10 to 20%, three catastrophic things happen. First, inflation explodes. A weaker dollar means imported goods cost more. Oil is priced in dollars. If the dollar falls 10%, oil effectively becomes 10% more expensive for U.S. consumers. Even if the global price stays flat, food, electronics, clothing, anything imported becomes more expensive. The Fed is trying to fight inflation. A collapsing dollar makes that impossible. Second, borrowing costs spike. The U.S. government needs to sell trillions of dollars in Treasury bonds every year to finance the deficit. If the dollar is weakening, foreign investors demand higher yields to compensate for currency risk. That means the U.S. has to pay more to borrow. Higher borrowing costs mean even larger deficits. It's a death spiral. Third, the dollar loses reserve currency status. Right now, about 58% of global foreign exchange reserves are held in dollars, down from over 70% 2 decades ago. If that number falls below 50%, the dollar is no longer the dominant reserve currency. And if that happens, the U.S. loses its ability to run massive deficits without consequences. The standard of living in America collapses. J.P. Morgan's research shows that de-dollarization is unfolding in central bank FX reserves, where the share of USD has slid to a 2-decade low. The main de-dollarization trend pertains to the growing demand for gold. Seen as an alternative to heavily indebted fiat currencies, the share of gold in FX reserves has increased, led by emerging market central banks. China, Russia, and Turkey have been the largest buyers in the last decade. The World Gold Council's 2024 survey revealed that 76% of central banks now intend to increase their gold holdings over the next 5 years, up from 69% last year. Meanwhile, 75% plan to reduce their exposure to dollar-denominated assets, up from 62% the year before. But the chart I'm about to show you changes everything. Because while de-dollarization is accelerating, there's another force at play. BRICS, Brazil, Russia, India, China, South Africa. These 5 nations, plus dozens of others now applying to join, are actively working to bypass the dollar in international trade. President Trump has threatened 100% tariffs on any BRICS nation that attempts to create or support a currency to replace the dollar. But the threat isn't working. Trade between BRICS nations increased by over $700 billion between 2021 and 2024. They're rebuilding new cross-border payment systems. They're exploring blockchain technology. They're trading in local currencies. Russia and China are already conducting bilateral trade in rubles and yuan, bypassing the dollar entirely. India is buying Russian oil in rupees. Brazil and Argentina are discussing a common currency for South American trade. The dollar's share of global trade has already fallen from over 70% 2 decades ago to about 58% today. If BRICS succeeds in creating a viable alternative payment system, that share could fall to 40% or lower within a decade. And when that happens, the U.S. loses its sanction power. It loses its ability to print money without consequences. It loses its exorbitant privilege. The Atlantic Council published a report titled How to Dismantle a Reserve Currency. It warned that Trump's policies are breaking from the long-standing post-war view that the dollar's reserve currency status is in the U.S. interest. The report stated, as uncertainty about the United States' political commitment to the dollar's reserve role grows under this administration, the currency's appeal will diminish. Foreign governments that rely on the United States for security tend to hold a higher share of their foreign exchange assets in U.S. dollars. But if trust in the U.S. alliance network breaks down, those governments will dump dollars. And once that process starts, it accelerates. So here's the death spiral scenario. The dollar falls another 10% over the next 12 months, hitting 1.25 against the euro. Inflation in the US spikes as import costs surge. The Fed is forced to hold rates higher for longer, even as the economy weakens. Recession hits. Tax revenues collapse. The deficit explodes to $3 trillion or more. Foreign central banks accelerate Treasury sales. Yields spike. The US government's debt service costs become unsustainable. The Fed is forced to intervene and buy treasuries directly, expanding its balance sheet and printing money. That triggers even more inflation. The dollar weakens further. It's a feedback loop. At that point, the US faces two choices: fiscal austerity, slashing government spending by trillions of dollars, triggering a depression, or currency debasement, printing money to inflate away the debt, triggering hyperinflation. Peter Schiff, the economist who predicted the 2008 crisis, has been warning about this exact scenario. He says the Fed will keep cutting rates in 2025, triggering a US dollar crisis and a recession, sending consumer prices and long-term interest rates soaring. He's betting on gold. Because when the dollar collapses, hard assets are the only safe haven. Goldman Sachs is forecasting EURUSD at 1.25 by end of 2026. Morgan Stanley expects another 10% in losses. JP Morgan says de-dollarization is accelerating. Central banks are dumping treasuries. Gold reserves just overtook dollar holdings. The dollar just fell 11% in 6 months, the worst decline since 1973. The second act is coming. The death spiral has started. Are you watching the show, or are you positioned for the collapse? What do you think? Drop your answer in the comments below.